Hello, CBP. What's happening? Thanks for having me. My name is Adrian Brinkley. I'm out of Asheville, North Carolina. Today, I will be speaking to you on behalf of GHJ on the benefits of comparing your financials against your total barrels sold. I have 5 years of experience in craft brewing accounting across a handful of breweries. My responsibilities have included closing the books each period, annual budgets, cash forecasting based on income forecasting, and internal reporting. I'm excited to talk with you today about my favorite metric in the craft brewing accounting world, and that is how and why do we compare our financials against our total barrels sold, and how this impacts management decisions and subsequent forecasting updates. All of this is in an effort to better understand your gross margin month over month. By the end of this presentation, you should understand the benefits of using this metric, understand what makes this metric tick, and how to communicate this information back to applicable management. The official name of this presentation is Barreling Towards Success. Pretty clever, right? We have our table of contents, pretty basic stuff, beginning, middle, and end. Let's go ahead and get into this, though. This is all going to be centered around how each barrel impacts your gross margin. What does it mean? Why is it important? How are we doing it? Well, we're selling barrels of beer. And when we're selling beer, there are two important questions to consider. Is the beer good? Will it sell and will it continue to sell? Question number two, are we financially successful in selling beer? That's the big question. How do you tell if you're doing well when there are so many moving pieces that impact your gross margin month over month? Because your gross margin is so vital to brewery success and growth, how can you better understand how it moves? Let's say you're looking to expand your brewery. This analysis will serve as support for any upcoming capital spend plans. And what do you need if you're wanting to invest a lot of capital into your business? Accurate income and accurate cash forecasting. And does the income statement alone paint the full financial picture of your performance? Today, I'm going to talk about a deeper layer of analysis into your income statement that can provide clarity on differences between budgeted revenue and budgeted COGS versus your actuals. This deeper layer of analysis is found by comparing your total barrels sold versus your total revenue and total COGS. Because the income statement is solely dollars, the value of each barrel sold isn't clearly explicit without this comparison. By the end of this, you can say, okay, well, I'm looking at the income statement this month. Looks okay, or not so great. Based on this comparison, we can say, okay, it wasn't that bad or it wasn't that good. In the upcoming slides, I will explain what needs to be done in order to get this metric in good working condition. Basically, how do you get your processes up to par for information to flow accurately into the books? For example, before comparing your total barrels sold report to your books, ask yourself, is the total barrels sold report complete and accurate? Furthermore, is it processed consistently, period over period? Then ask yourself, are your COGS being recognized in the correct periods? With that, consistent inventory adjustments between COGS for packaged and draft. And lastly, has everything that needs to be accrued been accrued? As a footnote, I know some breweries will be on accrual basis accounting, while others are on a cash basis, and that's fine, whatever works best for you. While the comparison of revenue and COGS against barrels sold in a cash book might have larger swings month over month relative to an accrual book, it is still important to measure your total barrels sold against revenue and COGS in an effort to understand your gross margin over a period of time. I will then explain what to look for in the analysis of barrels sold versus gross margin. Essentially, what makes the metric move. Now, this isn't just an accounting exercise for fun. So, most importantly, how do you take the results of your analysis and communicate them back to the rest of the company? And what impact can this analysis have on not only how the accounting department is forecasting cash, but how these findings can serve as backup for adjustments in operations of the brewery? A deeper layer of analysis. So what exactly are we talking about? We're talking price per barrel, aka revenue per barrel. On simpler terms, how much cash came into the business for how many barrels you sold. You've got $100,000 in sales and you sold 1,000 barrels. You generated $100 in revenue per barrel. Now, this isn't the only number to look at. So how many dollars did the business keep on the barrels that you sold? So we're talking about gross margin per barrel. You've earned $100 in revenue for every barrel you sold. However, it costs you, let's say, $50 per barrel to generate that revenue. So your gross margin per barrel is $50. How does this metric impact your budgeting, forecasting, and operations? In short, taking the planned barrels for the year based on what production says they can produce and what sales says they can sell, and backing into projected revenue and COGS based on that projected price per barrel and gross margin per barrel. Now that we have that baseline, we can use this metric in our comparison of budget to actual dollars, and then forecast as needed using the latest information available. So what does this metric mean for the operations of the brewery? Depending on where the margin is trending, we're looking at potential changes in pricing, variety, strategy, and really looking for ways to drive costs down. In the next section, I will talk about the processes that need to be in place in order to get the most accurate representation of how the brewery is working. All right, let's talk about good books. Bad data in, bad data out. Before we compare our books to a report of barrels sold, let's make sure everything's running in the same direction. We're talking about the accounting processes and operational processes that impact the material accuracy of this metric. So whether you're using a formal production software or it's tracked by hand, more of a cowboy accounting style, you need to ask yourself, is there a consistent and accurate process in place for production and sales to feed accounting with information? Let's think revenue, COGS, and total barrels sold. Revenue. Does all the beer that was sold in this period have an applicable invoice or tasting room sales receipt? Are all the tabs closed out and are all the invoices posted? And really, is all this information flowing into the books? COGS. Were all inventory items checked in? Were there inventory items that arrived at the production facility, but the bill hasn't been received yet? Did a truck go out full of beer, but we're waiting on the bill? Basically, there needs to be a line of communication between production and accounting in order for accounting to be able to fully represent what happened down on the floor. In order for your COGS value in the books to be correct, there needs to be a consistent process for a physical count of inventory between raw materials, WIP, and finished goods. Since we're looking at price per barrel and gross margin per barrel on a monthly/quarterly basis, I would recommend either a monthly or quarterly count. We want to make sure there are no surprises at the end of the year if, say, you're only conducting an annual physical count. Lastly, let's talk total barrels sold. And this kind of ties in with how we ensure sales are correct each period. But really, can we confirm that all the beer that left the building has an invoice or a tasting room receipt? And making sure that confirmation has happened with accounting before accounting closes the books and runs their analysis. All right. Now that we can ensure the information from production and sales is flowing into the books, we need to make sure our books are good. What are good books? They are materially accurate books, consistent, timely, and complete. If nothing else, be consistent. And we trust the books if this is going there that month, but another place this month. Timely. Was the information relayed too late? Has everything been included? What accounting processes can impact how gross margin is reported each month? Breaking it down into a couple of items, we've got payroll, in particular, payroll for production employees. Can we ensure that all production payroll expenses are being mapped to the correct COGS account? This may be a matter of working with your payroll processor to ensure account mapping by employee is correct. Lastly, I would recommend establishing an accrual threshold for your books. As it relates to accrual accounting books, are you comfortable recognizing a certain amount all at once, or would you rather see it recognized over a period of time? For example, let's say you get a discount for prepaying your annual production software subscription. Well, do you recognize the production software COG all at once, or do you accrue it over the life of the subscription? To take your book one step further, the use of class tracking can better help you understand where your sales are coming from, where your spend is going by revenue stream. Class tracking is essentially an extra layer of detail that may not be explicit in your GL. When tracking your books by class, you're simply tagging each transaction to its applicable class. Typical classes include admin, production, sales, and taproom. All of this is in an effort to view each revenue stream as its own individual business. This is particularly important if you have multiple taprooms. So your GL has one total taproom sales account. However, by class, you can now see how each taproom's individual sales contributed to the overall bottom line of the company. Being able to view your overall business by each individual class can improve reporting back to the applicable class, which in turn provides support for operational decisions. So now that processes are in place to ensure our books, production, and sales reporting are speaking the same language, let's compare our books against our total barrels sold. Things that can swing price per barrel and gross margin per barrel. In using this metric of price per barrel and gross margin per barrel, we can essentially build out a budgeting template for estimating gross margin. So you've got a plan. Next year, you want to produce and sell X amount of barrels. You know what kind of beer you want to sell, lager, IPA, some specialty, and you know that you'll sell more of it in the summer than you will in the winter. Some of it will be put in kegs and the rest of it in cans. How much are you going to charge for it, and how much is it going to cost you? But the big question is really, how does a swing in this product mix impact your gross margin per barrel? All right, let's pop over here to our Excel workbook and see how this comparison is made, analyzed, and updated. Here's the fun part. I had to make sure you knew where everything was coming from before we looked at an example. Anyways, in theory, this would all be easy if you sold one type of beer in one packaging type. If you hit your barrel goal, your revenue goal would follow. However, not all barrels are created equal. We're selling all sorts of beer at different price points, different margins, and different packaging types. Furthermore, you look at the same barrel of beer sold through the tap room versus wholesale, and there is a drastic difference in how much revenue it brings in. So in order, pause. So in order to budget for upcoming revenue and COGS, we need to flesh out how these product mix splits will impact our dollars in the books. So in establishing a plan, aka a beer calendar, You need to work with production and sales to see what kind of product mix they're anticipating for a certain period of the year. For example, the brewery is planning a specialty release to hit in Q1. This release is going to be more expensive relative to the regular offerings, so we should plan for a different margin for Q1 compared to the margin for Q2. Even if you have prior year data to use as a baseline, it is important to flesh out the product mix plan for the upcoming year in order to best estimate material swings in price and COGS. Let's put together an average price per barrel and average gross margin per barrel based on the planned split between draft and package. You're going to want to average this out per quarter or whatever makes sense for your planned product mix swings. Your planned barrels are split down the middle between package and draft. So your barrels are split 50-50. What does that mean for your average price per barrel and gross margin per barrel? Well, we're backing into these dollars. So 500 barrels at 120 price per barrel for package will turn out $60K in revenue. 500 barrels at 80 price per barrel for draft will turn out $40K in revenue. Since the split is the same, let's average the two together, leaving us with an average price per barrel of $100. We want to do the same thing for COGS. 50-50 split, we're projecting 500 barrels costing us $40K in packaging COGS, 500 barrels costing us $10K in draft COGS. Averaging those out and comparing to our average price per barrel, we're looking at an average gross margin per barrel of $50. Now that we have a baseline average, now that we've got a baseline average, let's work through the comparison to our actual. You'll see here that we have our actuals in blue, budget from the previous tab in green, and the difference in yellow. Our job as accountants is to analyze the comparison to figure out why it is the way it is and determine if we need to make any forecasting updates for future periods based on what the actuals are telling us. For this example, in order to keep it easy to understand, we've got our budgeted barrels and budgeted revenue COGS, the exact same for the first 4 months of the year. In theory, this will not be the case for your plan. In my experience, beer sales are seasonal. Again, your sales in the summer are likely higher than your sales in the winter. What does that mean for your gross margin per barrel throughout the year? It's likely you have a full-time production staff, and that production staff has a somewhat predictable value for labor COGS. They're making beer to sell in a later period, and they're doing it all year long. However, you're likely recognizing that labor on the income statement in the period it's incurred, as opposed to capitalizing it on the balance sheet until the sale is recognized. And that's fine. But with that, the production labor COGS are kind of fixed. Basically, the labor portion of COGS doesn't necessarily move with recognized sales. So if you have slower sales in Q1, your COGS will kind of be overstated for that period because you're recognizing COGS on beer that hasn't been sold yet. However, when sales pick up the following quarter and you're selling that beer that was made last month, your COGS for the current period will be kind of understated. For some of those labor COGS have already been recognized on the beer you just sold. Let's look at how our actuals compare to our budget. And let's see if we can identify a trend in that variance that'll call for a forecast update for either revenue, COGS, total barrels, or all of the above. For these examples, we'll keep it pretty straightforward. Basically, one account changing at a time. But note that in reality, these accounts will all be moving in all directions. If actual revenue is higher than the plan, let's go over here and say hi, but total barrels sold hit the plan. We're seeing a $10 difference per barrel in how much revenue is coming in. What if actual revenue hit the plan, but total barrels sold were higher than the plan? And not so good. 100K on 1,100 barrels. Relative to plan, we're making nine less dollars per barrel than we thought we were going to. And what if we hit our revenue goal and we hit our barrel goal? Then awesome. However, our actual COGS per barrel were higher than planned. We've got that difference coming down at the bottom. Even though our revenue's tying out, looking good, we have underestimated our COGS per barrel. And after we've drilled down into our gross margin, we can identify what made our gross margin move against the plan between revenue, COGS, or total barrels sold. Our job is pause. Our job as accountants is now to communicate it back to production and sales to determine how good or how bad. Little pause. That conversation could go something like this. Let's say our price per barrel and gross margin per barrel were exact. Pause. Let's say our price per barrel and gross margin per barrel were exactly as planned. However, we sold 10% less barrels than we had planned for. What does that mean? Our percent margin was correct, great, but because we sold 10% less barrels, we're showing 10% less dollars in sales and 10% less dollars in gross profit. Now, in theory, we have that extra 10% of barrels sitting in finished goods inventory. We need to determine if those barrels will be sold in an upcoming period. If so, we need to forecast an updated plan that says we're going to sell 10% more barrels in the upcoming period than we had originally planned. And they'll be at the same price per barrel and gross margin per barrel. So we'll be back on track with the original plan. 90K in revenue for January and 110K in revenue for February. Good news, we're back on track year to date. That's pretty good. The conversation could also go something like this. Let's say our price per barrel hit our plan and total barrels sold hit our plan. However, the COGS on those barrels were higher than we had planned for, aka less dollars in gross profit. We're taking that information back to production to see if they expect that COGS percentage to continue to trend in this direction. For example, let's say we had budgeted for a price increase on packaging materials. However, there was an additional price increase on packaging materials that we didn't plan for. Based on that information causing a material difference in how our actual COGS are trending to plan, accounting needs to make an update to our rolling forecast to say we are now planning our gross margin per barrel to be less than what was originally planned. As you move throughout the year, we're looking for trends that arise in this comparison, and we need to be able to determine if a trending difference is material enough to make a forecasting update. For example, let's say your gross margin per barrel for the first 6 months of the year is trending at 2% less than what you planned for, and you're planning for that trend to continue throughout the rest of the year. How does that 2% translate into dollars, and does it have a material impact? Probably not, as opposed to, say, a 20% variance, which at the end of the day is a 20% variance on contributed capital. This and updating is dependent on a constant feedback loop of information between accounting, production, and sales. Production is keeping sales and accounting up to date with how they are tracking against the barrel plan. Do we have the beer to sell? Sales is feeding accounting with their projected CEs or case equivalents, then converted into barrels. And accounting is updating their forecast based on all of this. We are painting a financial picture and plan based on that information, and it is constantly being tweaked and adjusted. Last time. And I'll quickly note that differences in your price per barrel and gross margin per barrel against plan won't be by the same percentage. So if you've under forecasted sales by a certain percentage, so if you forecasted sales by a certain last time. So if you've under forecasted sales by a certain percentage, any difference in COGS will likely be by a different percentage. So let me pop over here to this sheet. Same thing, except we can take revenue, COGS, and barrels and play around with the percentages. So revenue is really good. Barrels are up too. So not as good. And your COGS are low to make up for it. How can you leverage this analysis? We can use this analysis in a handful of ways. Accounting is sharing the results to applicable management, and together we're trying to put together a revised plan of action. As accountants, we're responsible for saying how much cash we have today and how much cash we're going to have tomorrow, or in a month, or at the end of the year. Keeping a constant eye on how this gross margin moves is essential for forecasting or estimating cash. Let's say you're heavy in cash right now relative to your plan. Before you go and spend that cash, does your forecasted price per barrel and gross margin per barrel support that spend? Or if you're light in cash, does your forecast indicate that it'll trend upwards? But timing is everything. So closing these books and analyzing your gross margin as quickly and accurately as possible will help the company be proactive enough to say, okay, we can afford this new hire, or we should tighten the belt a bit. On the operations side of things, we can leverage this analysis in our planned product mixes. Does the pricing for each variety, for each packaging type, support how much we are expecting to see in gross profit? It is important for the operational plan to know what impact a shift in product mix between draft and packaged, or a shift between an expensive beer and a cheap beer will have on the overall contributed capital for the company. Basically, what is selling, and is that the best use of our production capacity? Thank you all for watching, and thank you CBP and sponsors for having me. If you have any questions about my presentation or would like to learn more about how GHJ can support your brewery's financial health, please reach out to my team or find us on LinkedIn.